Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The neckline of the August to November 2021 complex triple top, which is currently at 24.47, was, and maybe still is, part of what I suspected 14 weeks ago, part of a new pattern. Is the November 2023 to either to date or until January this year descending scallop pattern. The neckline plus the congestion between 23.90 and 24.08, containing a July 2012 high at 2400 and a 50% Fibonacci line of the combined March to November and November to December 2023 moves, all these together provided overhead resistances. Now, going back to the descending scallop pattern, this backward letter J pattern finished its run upwards as the target on the upside for the run up was in the 24.05 area. And it started its second decline since late January. The steady decline from late January through changeover 3 weeks ago had, for the most part, run along down the underside of the purple highlighted upper tine, currently at 22.25, of the early November 2023 to mid-January 2024 bearish shift pitch hook. 3 weeks ago, there had been a strong drive higher over the upper time, but the move up failed at the overhead congestion between 23.90 and 24.08, containing that important 24.05 area. And by the end of that week, prices had turned lower. We then had the changeover with gap down well into stratified congestion zones. 21.40 to 21.48, 21.0 even to 21.07, 20.69 to 20.76, 20.47 and 20.03, where prices started to get stuck. I said last week, and I quote, "I would note the role of the big red highlighted April 2020 to date uptrend has played in seemingly securing the downside." Currently at 20.69, that one. So we have left behind not just a descending scallop pattern, but a changeover gap move lower, and also a weekly reversal down 3 weeks ago. So that's 4 weeks ago now, on the continuous charts. Now the market is not moving there right now, but should prices go all the way down to the low 20s, as they did back in late December last year, then I will likely have some significant targets below. One secondary target, which is currently off the bottom of my daily chart. It all now depends if the stratified congestion below will be strong enough to not just slow down the market, which it has done already, but eventually halt the market and turn the market higher before it has a chance for a confirmed break below 20 even. End of quote. Well, that bright red uptrend held the market up during the start of March, and we've since seen a move higher, up and out of the stratified congestion between 20.47 to 21.48, such that we are today once more tackling the purple upper tine and almost filling in the changeover gap. Now, that would be fine on its own, but we have a congestion dead overhead at 22.35, plus nearby the short medium moving average currently at 22.60. So I'm cautious of any further moves on the top side. That all being said, there is an elegance to any break higher, so I would pay close attention to the purple upper tine and the nearby resistances mentioned, because we could easily see a move up to the congestion overhead from around 24.05 again, which we saw in late February. Ice Europe, white sugar in London. The market at the start of March had been wading down through stratified levels of support and turning it into resistances above, such that prices had dropped down to below the interesting 625.30 to 602.70 congestion area, and even dipped down below the breach but unbroken support of the purple coloured uptrend, currently at 603.90, dating from October 2022. There was some further congestion below between 590 to 592.80, which finally held up prices before we saw a move back up at the start of last week. I said the following 6 weeks ago, and I quote, "In the process of falling, hesitating and then rising, the market created, just like in New York sugar, a November 2023 to date descending scallop pattern. The question here is the same for London and New York sugar. What's next? Well, typically for such a descending scallop pattern, there are two pathways. You'd expect a hesitation around the 670.90 area for a short while, for either a drop back down to the December low zone down in the 585 even zone, or you could see after a hesitation a fresh move higher that will punch up through the November 2023 high in the 772.90 area. End of quote. Since that commentary, prices had a changeover gap lower, which was part of a larger move lower. I said 2 weeks ago, and I quote, we are realistically looking at a potential test down to the December 2023 lows down in the 585 zone. This prompted me to draw a bright red, an early November 2023 to late January 2024 bearish shift pitch hook. And though prices have not slid along the underside of the upper time, currently at 625.30, as they did in New York, the bearish shift pitch hook still shows the bearish angle of attack of the market, with prices in between the upper time above and the middle time below. End of quote. Well, the purple uptrend has put all that into question, as prices have risen enough now that we are testing the upper time, and with that the whole concept of the descending scallop idea. We could possibly be seeing the start of another different pattern. Now, it is too early to say yet, but I do see elements of a potential double bottom pattern since November last year. It all depends on which gives way first, the red upper tine or the purple uptrend. What I would note is these crossovers in early April, so a decision may be coming sooner than some may think because of that early April crossover. By the way, I will add the following comments made by me last week, and I quote, the market has become caught in the viscous congestion zone between 625.30 to 602.70, which I now extend to 585.10 to 625.30, so it's much bigger. The breached and seemingly unbroken purple uptrend is now reinforcing that viscous congestion zone, whilst the bright red upper tine is coming lower each day to meet the market from above. And that's the end of the quote. Sugar white premium spread. It must be close to, if not over a year here, that this chart continues to be one of the busiest and most colorful of all my charts. Many things still going on all at the same time. Okay, so I previously spoken some while ago about two big picture items in here on this weekly chart. We have the recurring big old bullish Andrews pitch hook from 2019 to 2021, highlighted in dark blue on my weekly chart, with prices currently testing, yet again, the lower time below, currently at 131 even. I've said this so many times before, and I'll keep repeating it here yet again. This pitch hook, despite being breached in the past, still continues to show the overall major bullish angle of attack of this market. In more recent activity, we have seen prices around and on occasion down through all the moving averages, notably the long moving average currently 130.5, which is the lowest, and the medium moving average currently 140.25, which is the highest. We also have the 250% Fibonacci lines at 128.75 and 131.5, as well as the June 2020 high at 134 even, for the market to deal with and try or not try to overcome. In the last 4 months or so, the market, despite some sterling efforts, has become somewhat trapped between the overhead congestion between 152.75 and 155, and between 128.75 to 134.75 further down. We have congestion again between 162.75 and 164.75, and once more between 173.75 and 175. Whilst below, well, we don't have that much below, apart from this October 2023 low at 118.75. Now, the market could maintain itself sitting here between the nearby supports below and the resistances above, though it may have to make a decision soon, as the dark blue lower tine of the 2019 to 2021 bullish Andrews pitch hook pushes up over the 128.75 to 134.75 congestion support. By the end of April that will happen, so keep an eye on it. The question remains as to whether the market has enough ammunition to push down through this congestion support below and ultimately break the lower time and the long-term bullish Andrews pitch hook. I'm still not sure on this point. You see, we've had lower prices in September and October last year, but eventually they turned higher, leaving an island pattern behind. But back then, the lower time was down in the 113 even area, not where we are now, over 130. I will nevertheless be paying close attention to what happens at and near the lower time. Just to remember that it requires a minimum of 2 consecutive weekly closes below the lower time to even make it consider it being broken. And given this market, I imagine it might need a few more consecutive closes than that to confirm it. I'm going to reach out and say that. I'll only point out one other thing. Below the dark blue lower time is another lower time, currently at 119 even, not highlighted. But this time is from the non-highlighted August 2021 to September 2022 bullish shift pitchfork. That one might come into play if the highlighted blue one is properly broken.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.